Well, thanks for tuning in to Bloomberg Quint. This is the Mutual Fund Show. Every Wednesday at 12:30 you have your appointment with me. And quickly tell you what's happening on the show. All through the last few episodes, we've spoken about the merits of investing in mutual funds. Yes, there is merit, which is why we are doing the show. But as is the case with every investment, it's always sound practice to have in mind the perils, the pitfalls, the potential short-term, long-term obstacles that stay within these realms of investing, and that is what we try to do today. Tell you about what you should keep in mind while investing in mutual funds. All may not be hunky-dory all the time. How should you prepare yourself for that? So that's the nature of the discussion that we are having over the next 30 to 45 minutes with our experts. Also on the show a bit later today, Tarun Bidani, founder and CEO of TBNG Capital Advisors, will be joining in to talk about funds that you could look to invest into. But right now, to deliver this really good message, chasers are losers. Let me read it out for you. Research shows that over a 10-year time frame, if one invests only in top performing funds of previous years, your returns would be lower than if you would stick to one fund throughout the tenure. So what's done in the past will do well in the future. That theory may not be completely true. Past performance belongs to the investor who invested then. It is not yours to chase. This is the message that is being given by Kalpen Parekh of DSP BlackRock. He is our special guest on the show today. Kalpen, thanks so much for joining in. Thank you. This is very interesting, Kalpen, because we normally talk about how people will benefit via a investment. What we are trying to do and what a mutual fund president and CEO is trying to do is try and tell people what you should not do while you're investing. Why this?
So I reiterate and reinforce what you said, that mutual fund is a great vehicle of disciplined investing, and it allows you options right from one-day money to maybe money for a century, because it has multiple ranges of products and risk profiles that investors can participate with liquidity, transparency, tax efficiency. What is also important to know is when you invest in funds which have an asset class which is cyclical, for example, equity markets are cycles, right? There are long cycles, there are short cycles. There are times when the asset class does very well. There are times when it consolidates, and there are times when it goes down. For investors who have started investing in the recent times, and I think the last couple of years mutual fund industry has really grown significantly, acquired a lot of new investors. I think it's important for us to give a very honest and credible message that we are happy you have started investing with good mutual funds. But remember one thing, these are long-term investment vehicles, and in the journey of long-term returns that you look for or aspire for, there are lots of periods of short-term volatility, and if you are aware of it upfront, you will be able to navigate the short-term volatility much better. So knowing that you're investing in a long-term vehicle is easy before investing, but once you are in and the ride turns volatile, and mutual fund or equity mutual funds as an asset class tend to go through ups and downs, investors need to be aware of that. Okay. And we would be very happy to have investors who really invest for long periods of time. Now, data globally as well as in India shows that on an average, investors' time horizons tends to be around 2.5 to 3 years. Now, 2.5 to 3 years really don't give you any compounding. Okay. If our money is for long term, if our needs are for long term, many of us have needs for retirement, which is, let's say, 20, 30, 40 years down the line. Why invest for 30 months? Why not for that longer time horizon? Okay. So that's the essence of what I would like to highlight.
So that's something that we've been telling people for a long time as well, and I think we'll talk about that too. But first, I want to drive home this message, Kalpen. I think the basic philosophy of every investor in mutual funds, at least the ones that we've come across, is that look at what funds have done over the last few years. If those funds have given good returns, if they are 5-star rated, 4.5-star rated, so on and so forth, then those are the funds to invest into because they have given returns. There's a proven track record. That's the most sure shot way of investing in funds, isn't it? Why are you saying that chasers are losers?
It's a very valid question. How do you really choose? There are hundreds of funds available.
And hundreds of advisors showing 100 different methods
products,
of choosing
absolutely. So obviously a new investor tends to get confused. So there are some very simple frameworks or formulas, and I think what I would encourage is to look for simplicity rather than complexity in investment principles. If there are 500 funds, what is important to know is no fund will be the best performing fund every year. because your portfolios may be good companies, they may be good companies over a medium to long term periods. The stock prices will do well over time, but there are periods when they don't do well. One cannot expect a mutual fund portfolio to change every quarter or every year to participate in what is going to do well in the next 3 or 6 months, and that's prediction, that's forecasting.
Sure.
That never works. Good to expect, but almost impossible. I would say that go with evidence. Look at data. So do this analysis, and a lot of people have done this, that you choose the best fund every year, and the best fund every year changes. So the fund which was the best fund in 2005, do we even remember it today? Probably no.
No.
And it's very ironical. We spend more time researching which funds have given the best returns. But today if I ask anyone, including myself, that do I know what is the return of my portfolio in which I have invested for the last 15 years? I don't even know the number.
Right.
I broadly know that it will be X percentage. But we do not devote any time to performance post-investing, but a lot of time pre-investing, which is ironical. Coming back to this statement, data shows that you keep changing your portfolio every year basis the past performer. What are you doing is you are buying performance which is past. What you are investing is in the future.
Right.
So the framework says that what you buy for is good principles, good processes, good consistency, good longevity of your investment manager and his approach. Good managers also go through average or bad times.
Right.
A good cricketer will not score a century in every match, right? So fund manager will not deliver every month or every year. And ranking, you know, it's like school. The guys who are rank 1, 2 and 3 are not the only guys who are successful, right? So if you have 100 funds, there will be 100 ranks, and these ranks change every year. There is no science which can predict how the rank will change in the next year. Hence, it is futile. So a lot of data is available, but that data does not really give you any value add to take future decisions. Summarizing, what is important is to look for data over long periods of time and see which funds are beating their benchmarks consistently, which funds are sticking to their benchmarks, which funds are beating their benchmarks more often. So, you know, good fund managers also don't necessarily outperform every year.
Sure.
As long as 60-70% of time they are in the top 2 quartiles, I think that's a good job done.
So you would actually say go for a good fund manager and monitor that as opposed to betting on a fund house necessarily?
I wouldn't say that. I would say that it's a combination. You can't have both in isolation. A good platform allows a good fund manager to execute well.
Okay.
A good platform without a good manager remains incomplete. I'm only saying that look for continuity and consistency of returns rather than return at a point in time.
Okay.
Because a point in time can be misleading.
Fair call. Now we're trying to tell people, people often hear this thing, the magic of compounding, CAGR growth, believe in the formula of compounding, and how does it create wealth for you. You want to take some time and explain out here what is the most important element out of these 3 or 4?
I think this
Let's
is.
try and simplify this.
I'll try to simplify this. This is the most simplest formula we've learned in school, and we've all grown up learning the principle of simple interest and compound interest. I think if we remember this formula, how do I link this to investing? If you see the impact of every variable in this formula, P multiplies with return.
Right.
So the operator
P is the principal.
Principal is the money you save. You can save every month or every year, or whatever are your savings. So that's your principal that you're building in for investing. That gets multiplied by your rate of return, which you earn over a period of time. And the rate of return is generally not predictable, especially when you're investing in cyclical asset classes. So what is not predictable cannot be a barrier, cannot be a benchmark to really focus too much on. And T is the time for which you stay invested.
Right.
I want to just take you back to mathematically the importance of each of the variable. P multiplies with R is added. But the variable which has the highest impact is T, because it is raised to the power of. So the exponent, the impact in your A, which is the wealth you will create, comes maximum from time.
Okay. So just for simplicity, viewers, what Kalpin Parekh is trying to say is that the amount of wealth that you will generate is a factor of a lot of these variables, including the amount that you invest, which is principal, the rate of return, which is unpredictable. More importantly, time is what he's saying. So by this, you are trying to say that the time spent
makes the maximum impact.
Will have the maximum impact.
It will have the maximum impact, and it's not about what I am saying. It's about what this formula which we all believe in.
Sure.
Again, I'm saying maybe if you put the exponential there,
right?
It's beyond multiplication. So the impact of time. So instead of 5, if it becomes 10, the impact on A is much higher. It's not just 2 times, but it's much more because it's getting exponentiality. And the longer we stay, and data has proven that if you are an investor for 3 years versus 30 years, the amount of wealth creation can be much different. Apart from that, what is in our control, end of the day, what is in our control is how much can we save.
Sure.
We can't predict markets. They will have their cycles over long periods of time. Equity does well. Historically, that's a proven fact. And there are periods it does not do well. We cannot really time that. What we can really control is keep investing regularly. What we can control is keep investing more when prices are in your favor or they are cheaper or lower. Do what we follow in our day-to-day life. What is cheap, we buy more. What is expensive, we buy less. But give time to wherever you invest and stick with that.
Fair call. So now let's come to the crux of this discussion, Kalpen, and which is trying and telling people whether this is the right time to invest, and if you are investing right now, what are the pitfalls that you need to be prepared for? Nifty is at 10,000, markets are at momentous levels. People feel, a lot of people have this left out feeling as well, and a lot of people are now thankfully investing via the mutual fund route as well. What should they keep in mind? Would this be a one-way rally, or people should be prepared for downsides if you're starting to invest now?
So let me admit, I really can't predict how will the market look like in the next couple of quarters or years. It's very difficult to predict. Many people have tried to do it and it's a random toss. 50% of times you get it right, 50% you don't. What you know is over 10, 15, 20 years, markets tend to go up. Over 3 to 5 years, the outcome can be as random as up or down. So there's no, it's futile to try to, catch that journey. Now Nifty is at 10,000 points, yes, it's just a data point. Nifty was at 9,000 also, 8,000 also, but markets keep finding their own course. No doubt, what is important is to not extrapolate the supernormal returns that have come in the last couple of years for the future, because like I said, markets go through 3 phases, very high returns, average returns and low returns. So you have to be ready for all these phases in your investment journey. Very difficult to know when is that next phase going to come, and hence be aware. So again, we've done some data crunching which says that on an average, if your investment horizons are 6 to 7 years,
6 to 7 years,
around 7 years, I would say 7 year also is a economic cycle or a business cycle where you go through all ups and downs. Over a 7-year horizon, more or less, your even in the worst case environment, you tend to earn better returns than alternative investment avenues. And the beauty about mutual fund investing is it's tax-free end of the day. So you get that advantage of same.
Yeah, but I have questions which say that if I'm investing money right now, will the going be as smooth, or could my returns also enter the negative territory in the near term?
Of course, like I said, take the history of 35, 40 years of Sensex or 20 years of Nifty since it has been launched. Around 25% of times, equity assets have given negative returns. So that's a part of the game. If you take daily returns, 50% of time markets have given negative returns, 50% of times they have given positive returns, which is why I commented that on an average, if you have invested for 7 years, your probability of not just earning positive returns, but reasonably positive returns goes higher, as data over the last 40 years has shown. But no doubt, be aware that markets can go down.
Okay, now before we talk about some specific fronts from the DSP BlackRock stable as well, let's hear out Jayesh Khilnani from our research desk. He's compiled data of how there are funds over 3-year, 5 years and 10 years time frames as well, which may not have done well. So one, while it's important to allocate time and save regularly, it's also important to choose the right fund and stay invested for a long period of time. Hear out what Jayesh has to say.
Thank you for that, Neeraj. Well, often we have heard market participants saying that you have to invest for the longer term to generate higher returns. But contrary to this belief, time does not ensure outperformance. To prove this, let's have a look at some of the funds that have underperformed significantly over the last 3, 5 and 10 years. In the last 3 years, we can see that the Baroda Pioneer Mid Cap Fund has significantly underperformed the BSE Mid Cap Index. Moving on to 5-year performance, we can see that the Birla International Fund has also underperformed its benchmark, which is the S&P Global Index. And in fact, in recent times, the gap has just widened. Moving on to 10-year performance, the JM Basic Industries Fund has also underperformed its benchmark index. In fact, for the better part of the last 10 years, the fund had negative returns. So, all in all, it's not only time which matters, the fund and the fund manager would matter too. And I believe one such person is standing next to you.
Okay, thanks a lot for that, Jayesh. So that's some interesting data. And Kalpen, before we get to some specific funds out of the DSP BlackRock stable as well, because we got a lot of queries about it. I mean, the returns that the microcap fund has generated has been tremendous. One thing that we are trying to also, the data also shows, is that it's not always about the time spent. A lot of times, as would be normal case, the choice of funds becomes very important, and therefore, my question to you is, would it be advisable for almost every single investor who's starting off and doesn't have time to research himself to take the help of a financial advisor to have asset allocation goals and eventually make the choice of funds a lot more simpler?
I think goes without saying, because it's hard-earned money end of the day, and if you're not a domain expert in how to deal with money, it's better to go to domain experts. And India has lots of advisors who have seen market cycles over 20 years in the fund industry, who can actually guide investors much better. They say that if you put your money without knowing why you're putting your money, where you're putting your money, it's not investing, it's speculating. So the choice is yours, whether you want to be an investor or a speculator. I think either you be sure that you're a really good investor and you know everything very well, which is very rare, because I may be a good doctor, I may be a good cricketer, I may be a good professor, that's my domain. But managing money needs time, needs a lot of understanding of market cycles. I think the most important thing that we underestimate is the role of behavior.
Sure.
How will we behave in different points in time? So good advisors help you navigate the journey over time, give you advice at right points in time, help you choose, take away the complexity, and take you to achieve your long-term objectives.
Okay. My final question to you before we get to your funds is, I know it's difficult to predict, but to your mind, as we're sitting right now, what's the probability of long-term underperformance by an average mutual fund scheme? Either a time correction or a price correction, or a time stagnation or a price stagnation?
So I would call
by price, I mean NAV.
I would say 50-50, which is
50-50 right now,
which is a random outcome.
Which is a random outcome.
Yes.
Would it have been 50-50, say maybe when in 2014, or there you
so
would
I think I'll clarify a bit. At least data shows that more often funds have outperformed markets. So if markets underperform or markets go through a downside, then obviously even equity funds which are investing in equity stocks will go through a downside. I would urge investors or viewers to keep in mind that there's a wide choice available. Today you have funds which are balanced funds, which do a combination of fixed income and equity, which can cushion the downside if at all markets tend to correct. There are funds called equity savings funds which have 1/3 equity exposure and the rest is in fixed income and still give you advantages of equity taxation. They can be good options to start with. There are funds called dynamic asset allocation funds, which will navigate exposure between debt and equity depending on how valuations of bonds and stocks change, and they keep changing. So you as an investor can just be in that vehicle and let it keep adjusting the asset allocation. End of the day, the point is asset allocation drives all your final outcomes. So start with a certain asset allocation in mind. You have series of funds at different levels of asset allocation. There's nothing to say you should only be in equity funds, right? You should be in equity funds if you are under-owned or you don't have equity exposure and you are a long-term investor. If you have a moderate time horizon of 5 to 6 years, start with a balanced fund. So the range is available. Expand the choices. The choices are there. Ask for more choices. And I think I must admit that in the last 1 year or last 2 years, the fund industry has also raised a lot of assets in asset allocation and balanced funds, which in a way is evolution and maturity of the industry as well as investors. So they are not just chasing returns, but they are also starting to invest in asset allocation funds.
And I think from this perspective, what Kalpen is saying is very important. A lot of us don't quite understand, one, what asset allocation should be, and two, when should they buy a balanced fund, depending on the goal, depending on the age profile, depending on the risk profile, and therefore having somebody to advise you, it becomes critically important, and which is what we'll be doing a bit later on in the show as well. But Kalpen, can't let you go without talking about a couple of schemes from the DSP BlackRock end as well. Mind you, these are not recommendations coming in from Kalpen Parekh. We are merely discussing what's the nature of these schemes and how does he see them going ahead. I would have loved to talk about the DSP microcap fund, but you've stopped having subscription
But
there.
important to ask why we stopped. And,
okay, let's start with that then.
So, it has been one of our most popular fund because it has done exceedingly well over the last 4 or 5 years. We like the companies that we are invested in. But what we recognize is in the last 5 years, see again, like I said, everything is a cycle. Last 5-year cycle has been more favorable towards small caps and mid caps and micro cap companies. So they've seen a significant sort of jump in prices, stock prices and valuations. Our role or duty as a fund manager is to identify where do we see more value incrementally. We see significant opportunities in the large cap segment and select mid caps. We felt that more money coming in the micro cap segment, where liquidity is generally less, can tend to inflate prices further and may not give investors the same future experience as they have expected in the past. So it's okay to say no to money at some points in time and say that there are other options available. So I do tell friends and investors that if you have stopped micro cap, the question to ask is not when will you open it or which other micro cap should I invest in, because there's a reason why we believe in this space valuations have run up. So now, 2013, 10-year return of small caps were lesser than 10-year returns of large caps. So these are cycles again. So last 4 to 5 years, large caps have not done well, and we see that to be the opportunity going ahead. And hence, investing in a diversified equity fund will make more sense at this point.
So which is where the DSP BlackRock equity fund comes in.
Sure.
It's a
diversified equity fund.
And I saw some numbers since inception. The returns are about 20% if I'm not wrong. 5-year CAGR of 17%. What kind of investor should choose this fund?
So again, an investor who, I think diversified equity fund is the first entry point for any investor who's coming for long-term equity exposure, because this fund allows the fund manager to buy good companies. Now, good companies can be large caps, they can be mid caps, they can be small caps. So we should not be too fixated about the spread. But what's important is, are you buying good companies?
Sure.
The mandate allows us to buy good companies across the range of market cap and stay with them over time. The volatility is relatively lesser to pure mid cap or small cap funds. And again, relating to the question you had asked about performance, what is important here is to see that, okay, it has 20 years of track record. There were 5 years where it gave negative returns, but there were 15 years where it gave meaningfully higher positive returns for the overall 20-year return to be higher. So investors must recognize that, funds do have, markets go through periods of negative return, but you need to navigate them. Right. You can't get out of them, or you can't say, I know tomorrow it's going to come down. So the fund has delivered better return than benchmarks by around 6%. That's again the second approach. That is the fund beating benchmark, because that's the mandate. And if you are able to get that, that's how you choose funds keeping the long term in mind.
Okay, the other one is the DSP BlackRock Balanced Fund. Sure. What kind of investors? I think it's a history of 18 years.
Yes.
When we started the BQ Mutual Fund show, S. Narain was the first guest, and his recommendation was that people should start off at these levels with balanced funds as well. So different people have different opinions. But what kind of people, to your mind, should choose a balanced fund?
So I think people who are coming in the first time are getting exposed to equity investing for the first time, and may not have temperament for market volatility significantly, can start with balanced fund. Balanced fund, basically the beauty of these funds is its basic principle of asset allocation. So 65-35 is the exposure to equity and debt, and what it does is, on a real-time basis, as the exposure changes because of any asset class doing well or not doing well, it readjusts. The fundamental point here is, because it has two asset classes, it will always own one asset class which is doing well. Left to ourselves, left to our behaviors, what history has shown, we tend to chase the asset class which has done exceedingly well in the past. And if in the future it does not do well, our temperament makes us go away from it. Right. So balanced fund brings balance in our approach and helps us stay for a longer period of time. So it's good for a first-time investor. It's good for an old investor who may not want to see significant fluctuations. Sure. It will have lesser fluctuations. It will have 70% fluctuations than an equity fund, depending on its exposure.
Great. Kalpen Parekh, thanks so much for taking the time out and being with us on the Mutual Fund Show. Look forward to have you more often on this forum as well.
Thank you.
It is great discussing not just the merits in investing and how to invest, but also things that you need to keep in mind, potential downsides that you should be prepared for while investing in asset classes such as equities and thereby mutual funds as well. Really good of you to join us, Kalpen. Thanks so much.
Thanks.
Okay, that's the view from Kalpen Parekh of DSP BlackRock, and he clearly believes that the time spent in any asset class, I presume, but predominantly mutual funds and equities, is very, very important if you want to make returns over a long period of time. And don't follow past performances, because they need not be a right indicator of what the fund will do in the future. And I think that's the message that is coming in from Tarun Birani. He's the founder and CEO of TBNG Capital Advisors. Tarun, good having you. Thanks so much for being with us on the Mutual Fund Show. Now, I was looking at your views, and you believe that expecting returns based on past performance can lead to a lot of accidents. Would you give us an example of why you mean this.
Yeah. So Neeraj, I have seen investing into mutual funds. If we just quickly look at the inflows and the outflows number of at least the immediate last 10 years, and I could sense a big herd mentality of investing, wherein till 2007, in 2007 we had sizable inflow coming in. From 2008 to 13 we had huge outflow. Every month we had 500 to 1000 crores moving out of equity mutual fund. Post 2013-14, I think we have again started seeing surge in equity inflows. Currently we are topping around 5,000 to 10,000 crores every month. So I can just see a very clear pattern of herd mentality, wherein investing happens just because there is a change in the market currently. And I was just going through a quick number check, wherein anybody who would have invested with these behavior bias of herd mentality in last 10 years, taking out money, taking in money and all that, his CAGR return was approximately 10%.
Okay.
And somebody investing with a regular investing with this 10-year time frame with all these things, his CAGR was around 14.5%. Right. So we are talking about a 4.5% CAGR, and I'm sure you know what is the kind of money they have lost.
Right.
This is one accident. Apart from that, we have seen investors who are more opportunistic in nature, who just because a friend told, just because Neeraj told, a news anchor told, he would buy, right?
Right.
He has not done his goal part of it, right?
Right.
So, which is, again, I see that as a very big problem. What Neeraj requirement is, what Tarun requirement is completely different, right?
Sure.
I come from a very different DNA, I come from a different background.
And my needs are different.
My needs are different.
And
so
therefore it should be goal-based.
Yeah, so why goal-based is, it's like sitting in a cab and you don't know which way to go, right? You're telling the driver, take me anywhere you want. And I think that's where I see most of the investors, they are clueless what they want. So I think I feel this whole financial planning discussion or this investing discussion should more focused on the individual goals and need. Everything else can be taken care of.
And therefore the need for people who understand these concepts in a better fashion and discussing with them about your goals as well. Now Tarun, my question to you is, for people who are looking to invest into funds right now, this show is also aimed in a large part towards people who want to get an entry into mutual funds.
Sure.
And are thinking about what kind of fund should they choose right now, what houses, what schemes. So what would your advice be?
So again, Neeraj, there is no one-fit-all solution. It's a very, very specialized, customized approach, and I don't feel we can look at just recommending anything or anything to anyone. So they need to do the basic risk profiling part, wherein I have seen people with a 35-year age bracket also are in a very low risk bracket. It is because their parents have always been very low risk investor. Their financial situation had not been that great. That makes them very...
By low risk, you mean keeping money in fixed deposit?
Fixed deposit or 10-20% maximum risk profile. So we had such cases wherein a very high salary bracket guys also in 35 age bracket, their risk profiling was very low.
Sure. You think that shouldn't be the case?
Yeah, that was not the case. That was, as an advisor, my perception was, but that individual can't take risk. So I can't generalize, right? So I can't generalize. That's where my whole argument is, we just can't generalize. But yes, for a first time investor who has a 5 to 10 year time frame looking at today's specific market, I would rather go in a hybrid or a balanced category.
Why?
Big reason for that is it gives you a growth with stability. These are the two important markers of a balanced fund. If you look at the standard deviation of a balanced fund compared to a normal equity fund, it is approximately half of that. But if you look at 10-year, 20-year returns, they have delivered approximately 15 to 17% CAGR. So that makes me very comfortable, a tax-free return, low volatility, falling less than market, and gives you growth. I think what else?
What else do you require?
Yeah.
Okay,
yes.
so for a first-time investor looking to invest into mutual funds right now, balanced funds or hybrid funds could be a good
Makes
option.
more sense.
Now I was looking at your views. There are 3 funds that you're recommending.
Right.
Why these 3, and should people equally allocate amongst these 3, or should people choose one out of these 3?
So all these three funds, what I have recommended, Birla, HDFC and ICICI, all these have a track record of a 10-year plus kind of, all have delivered 15% plus CAGR, coming from good fund houses with good risk management, with fund managers who have been stable with these fund houses. That makes us very comfortable with these fund houses, and I think one can look at equally distributing money in these three.
Okay. One last question, Tarun.
Yeah.
For somebody who's willing to take that little bit of risk, is looking at the current market juncture, is balanced funds still a better bet, or would you tell them, without getting into names of the funds, would you tell them to get into maybe pure play equity funds or multi-cap funds or otherwise?
Yeah, so when this discussion moves on more customization and where the risk appetite is there, I think we will look at strategies like a pharma and a tech space, which last 1 year has actually underperformed.
Thematic funds.
Thematic. We could actually look at such strategies. Infrastructure is one play which more and more looking good from next 3-year point of view.
Okay.
So I think these are the plays we could look at somebody who is looking at a high risk. Yeah.
Okay. Tarun, thank you so much for being a part of the Mutual Fund Show and giving us your thoughts. So that's Tarun Birani saying that if you're a first-time investor looking to get into funds right now, haven't tested waters, maybe balanced funds is a good example right now. His thought process resonates with what S. Narain of ICICI Pru had to say earlier. Kalpen Parekh was saying today as well. Try and go out for balanced funds. Seek your financial advisor's opinion before investing. The funds that Tarun Birani is recommending are any of the balanced funds from the houses of HDFC, ICICI or Birla. So those are the funds that you can look at if you believe in Tarun, but do seek your financial advisor's opinion before making any investment decision. Thanks so much for watching this leg of the Mutual Fund Show. We'll be back next Wednesday at the same time to talk about yet another topic related to mutual funds.